Imagine you're driving a car and you desperately need to speed up, but you're being forced to drive with the brakes lightly pressed. That, right now, is a simple way to look at India's economy and its high interest rates. For years, these rates have felt stuck. If everyone knows they slow down growth, why can't the government or the RBI just hit a button and drop them to zero overnight? It seems simple, but the answer is a fascinating story of risk, patience, and strategy. Let's be honest, high rates have been painful. Think about a small bakery owner who needs a loan for a new oven, or a family buying their first home. The cost of borrowing is higher, making every step harder. We all feel it. But here's the kicker, these rates are actually hitting the government's wallet hard too. When rates are high, the government has to pay way more interest on its own massive debt. It's like borrowing money from your friend and then having to give them a huge slice of your paycheck every month. So, high rates are not a long term plan for anyone. So, if everyone agrees high rates are bad, why is the RBI still tapping the brakes? This is the core of the story. India is what we call a highly leveraged consumer economy. Translation: everyone, from you and me to big businesses, loves to borrow. Loans are everywhere: credit cards, mortgages, business expansions. If you suddenly make borrowing too cheap, too fast, you trigger a rush. People and businesses might take on more debt than they can actually handle. You risk creating a bubble. And when that bubble bursts, you see a surge in loan defaults. People who can't pay back their loans. The entire financial system gets wobbly. That's why the RBI has been the ultimate cautious driver. They knew short term economic speed might slow down, but their priority was bulletproofing the financial system first. They've been slowly letting the pressure out, making sure banks and lenders are strong enough to handle any bumps. And the good news is that patience is starting to pay off. The system looks much more stable now. This gives the RBI the all clear sign to start easing off the brakes. Over the next 3 to 6 months, we could see those rates finally start to gently inch downward. Lower rates mean the engine of the economy gets a boost. Loans become cheaper, demand for credit explodes, for homes, for expansion, for growth. Companies that focus on giving out those retail loans, like Aavas or Aptus, are often the first to see a surge in demand. The real story here isn't just about a percentage number. It's about a strategic slowdown today to unlock much more stable, sustained growth tomorrow. It's smart engineering. As always, this is just for learning, it's not financial advice. Do your own research, stay smart, and keep learning with Zalwora.